Leonardo Fibonacci was mathematically born in 1170 AD. From his work we get the Fibonacci series of numbers and also the well-known Fibonacci golden ratio. Hey there, I'm Polly, and did you ever skip match classes in school? If not, you probably at least heard of Fibonacci. Yeah, but it's not just a fancy pattern name, but actually the name of a real person. Today I'm going to dive into the fascinating world of Fibonacci levels and show you how to use them effectively. The Fibonacci series is a series of numbers where the next number is simply the sum of the two preceding numbers. So, for example, it would run 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and so on, with the sequence continuing indefinitely. It is based on the rate of reproduction of two theoretical rabbits, and the subsequent population growth in the following generations continue to reproduce. At first glance, it may seem somewhat confusing to find that there is a connection between a 12th century mathematical the rate at which rabbits reproduce and predicting the future direction of the financial markets using technical analysis. So, why is the series of numbers so important for traders? The focus tends to be on the ratio between the numbers in the sequence. This is considered to be the most important part of Fibonacci's work. Any number in the series divided by the previous numbers gives us 1618 as we get further down the series. This is known as the Fibonacci golden ratio in financial markets. The Fibonacci golden ratio has the same mathematical base as the natural phenomenon mentioned above. Let's talk about Fibonacci retracement levels. Fibonacci retracement levels are horizontal lines that indicate the possible support and resistance levels where price could potentially reverse direction. The first thing you should know about Fibonacci tool is that it works best when the market is trending. The idea is to go long or buy on retracement at the Fibonacci support level when the market is trending up, and to go short of sell off on retracement at Fibonacci resistance level when the market is trending down. Fibonacci retracement levels are considered a predictive technical indicator since they happen to indefinitely where price may be in the future. So the theory is that after price begins a new trend direction, the price will trace or return partway back to a previous price level before resuming in the direction of its trend. So let's examine the practical application of Fibonacci retracement with a real-life example, focusing on the British pound against the Japanese yen currency pair. We will enter a downtrend immediately. Instead, for 3-minute duration for 300, let's use 500. Now let's analyze the current situation. The first observation is the significant impulse. Let's plot Fibonacci levels based on it. We draw from the highest point, including the shadow, to the lowest point, including the shadow. Next, we notice a pullback. Let me mark it now, starting with the first one. The impulse followed by a pullback. As we can see, the pullback occurred at the 61% level. This level is ideal for the continuation of our initial impulse, indicating a potential price reversal. And what happened? We reserved. We reached the 38% level. Then we returned to the 61% level. Afterward, we reserved, broke the 38% level, and resumed our decline. Keen observers may notice the formation of a double top pattern within the Fibonacci retracement. This is how it looks. We have the first peak, the second peak, and from there on, I would see a sharp decline. I expect a further movement. A minimum target within this support zone. The situation should easily unfold in our favor, as everything else signs we downtrend. So let's wait for conclusion of the trade. Now let's summarize the concept of Fibonacci retracement. Only 3 seconds remain. We can see that our trade is closing profitably. Although the entry trade, the chart never surpassed our levels, confirming the effectiveness of Fibonacci retracement. Why does it work? In the trading world, there is a common law stating that after every impulse, there is always a pullback. Always. Fibonacci retracement provides insights into the mindset of this pullback. Sometimes it occurs at 50%, but more frequently at 61%. That's what we observe here. The pullback created at 61% and rebounded once again. And now a support level has formed. So, take advantage of it. I show many cycles specifically related to Fibonacci retracement in my Telegram channel, which contributes to our high success rate. I'm so glad that you watched the video till the end. Now you know all about Fibonacci levels. I hope you found it interesting and informative. Don't forget to subscribe to my Telegram channel. There was many more new videos ahead. If you wanted to participate in the trading session with me, subscribe to my Telegram channel where I share cycles only for profitable traders. My name is Polly. See you in the next episodes.